In today's episode, we're going to talk about something that most people didn't expect to hear in a positive light: high interest rates. For over a decade, we lived in a world of cheap money, near zero rates, easy borrowing, and low returns for savers. But now the tables have turned. Central banks have raised rates to fight inflation, and suddenly, savers are smiling again. Let's break down why high interest rates have quietly become a saver's best friend, how you can take advantage of this environment, and the smart moves to make while the window is open. 1. The shift from borrowers to savers. For many years, borrowers had the upper hand. Mortgages, car loans, and business credit were incredibly cheap. If you owed money, you benefited. But if you were saving money, your cash was being eaten alive by inflation and low returns. Now, things are different. Central banks have raised interest rates, not to reward savers, but to control inflation. Yet, the side effect has been a renaissance for disciplined savers. Today, your cash has value again. Your patience finally pays. 2. The inflation connection. To understand this shift, we need to look at inflation. As prices began to rise sharply, policymakers had to respond. Raising interest rates is one of the most effective tools to slow down spending and borrowing. But here's the unexpected gift. Higher rates mean savings accounts, certificates of deposit, and even short-term government bonds are offering real, meaningful returns again. After years of earning 0.1% or less, we now see accounts yielding 4 to 6%. For the first time in a long time, your money isn't sitting idle, it's growing. 3. High-yield savings accounts. This is where the transformation is most visible. Traditional banks still pay close to nothing. But online banks and fintech platforms are competing fiercely for deposits. Many now offer high-yield savings accounts that pay 4, 5, even 6% annually with instant liquidity. That means your emergency fund, your savings buffer, or even your short-term investment cash can earn hundreds of dollars more every year with zero risk. If your money is sitting in an old account earning less than 1%, it's time to move it. Remember, loyalty to your bank shouldn't cost you money. 4. Certificates of deposit, CDs. If you can afford to lock up your money for a few months, certificates of deposit are an excellent next step. Many banks are now offering 5% or higher CD rates for 6 to 12 months. That's a guaranteed return, and in uncertain times, guaranteed income is gold. The smart approach is called a CD ladder. You divide your savings into several CDs with different maturity dates. As each one matures, you reinvest it at the latest rate, so you keep your money both liquid and growing. 5. Money market funds. Money market funds have quietly become one of the most attractive places for short-term cash. These funds invest in government and corporate short-term debt. They're considered extremely low risk and right now yield around 4 to 5%. They allow daily withdrawals, so they're a perfect spot for large emergency funds or cash you're waiting to invest later. In short, it's a way to make your idle money productive without locking it up. 6. Bond or back. For the first time in more than a decade, bonds actually look appealing again. Government and corporate bond yields are much higher now, offering stability and consistent income for investors who seek less volatility than stocks. Retirees, especially, can once again build an income-producing portfolio that isn't tied entirely to the stock market. After years of being ignored, bonds are finally relevant. 7. The psychology of saving. But beyond the numbers, something deeper is happening. When interest rates were near zero, saving felt pointless. People were encouraged to spend, invest, or speculate. Now, with visible returns, saving has a psychological reward again. Behavioral finance tells us that humans need feedback, and higher interest provides exactly that. You can see your money grow. You're rewarded for discipline. This subtle shift is changing how people think about money, and it's a healthy one. 8. Balancing debt and saving. Of course, not everyone benefits equally. Higher interest rates also mean higher borrowing costs for credit cards, mortgages, and personal loans. So, the key is balance. If you carry high interest debt, it still makes sense to pay that off first. But once you've reduced the expensive debt, shifting focus to saving will pay dividends, literally. Your new strategy should be 1. Pay off toxic debt. 2. Build your emergency fund. 3. Then maximize your high-interest savings and investments. 9. Where to park your cash. So, where exactly should you put your money right now? Let's look at your main options. High-yield savings accounts for liquidity and easy access. Treasury bills, safe, government-backed, and currently offering 5% or more. Certificates of deposit, if you can commit to a few months. Money market funds, for flexibility with solid returns. Each of these options beats the 0.01% rates that traditional banks still offer. The lesson: your money deserves better treatment. 10. Pitfalls to avoid. Even in a good environment, there are mistakes to watch out for. Don't ignore inflation. Even a 5% yield means little if inflation spikes higher. Be aware of taxes on interest income. Some accounts aren't tax-advantaged. And don't chase the absolute highest rate without checking the safety of the bank or institution. Always make sure your deposits are insured and your provider is legitimate. 11. Real-life example. Let's bring this to life. Sarah had $20,000 sitting in a traditional bank savings account earning 0.5%. That's just $100 in a year. She moved it to a high-yield account paying 5%. And now she earns over $1,000 per year, risk-free. The future outlook. So how long will this last? No one knows for sure. Eventually, when inflation cools, central banks may start cutting rates again. That means the window for high guaranteed returns could shrink. Smart savers are acting now, locking in CDs, optimizing accounts, and setting up ladders while yields are high. The message: take advantage while it lasts. Key takeaways. Let's wrap it all up. High interest rates have finally turned the tide in favor of savers. You can earn 4 to 6% safely with no market risk. Move your cash to better accounts. Don't settle for less. Pay off bad debt, but let your savings grow in the background. The disciplined, informed saver will thrive in this new era. Closing thoughts. For over a decade, saving money felt like a losing game. Now, it's finally rewarding again. The era of free money may be gone, but for savers, it's the dawn of something new. If you understand how to use this environment wisely, your money can work harder for you, quietly, safely, and consistently. So, take a moment today to check where your savings live, and make sure they're earning what they deserve. This is the time to let discipline and patience pay off. Take care, and see you in the next episode.